Hey everyone, and welcome back to Financial Freedom. Today we're diving into a radical question. Can a government's decision unrelated to war or interest rates cause an economic crash? Sometimes recessions are triggered by specific, deliberate policy choices. Not just random economic hiccups, but decisions made in the halls of government. Buckle up, because today, we're examining two pivotal moments in American history that illustrate this very concept. Our first stop takes us back to the 1830s, a time of intense political and economic upheaval in the young United States. Picture this: Andrew Jackson, our 7th president, a war hero and a man of the people, is in a standoff with the Second Bank of the United States. The Second Bank was powerful, holding significant influence over the nation's financial system. Jackson viewed it as elitist, corrupt, and a threat to democracy. He vowed to destroy it. In 1832, Jackson vetoed the bank's charter renewal, a move both bold and, to many, reckless. He didn't stop there. In 1833, he ordered the removal of federal deposits from the bank. This was his knockout punch, intended to cripple the institution by starving it of funds. The consequences were swift and devastating. The removal of deposits sent shockwaves through the financial system. The bank, in a desperate attempt to survive, tightened credit, making it incredibly difficult for businesses and individuals to obtain loans. Economic activity ground to a halt. The nation was plunged into what we now call the Recession of 1833-34. Jackson doubled down on his hard money policies, issuing the Specie Circular in 1836. This executive order mandated that all public land purchases be made in gold or silver, further constricting the money supply. These actions are prime examples of policy-induced recession. Fast forward a couple of decades and we find ourselves on the eve of another economic crisis, the Panic of 1857. This panic had multiple contributing factors, from bank failures to over-speculation in railroads. But amidst this economic storm, a political bombshell exploded that amplified the crisis: the infamous Dred Scott v. Sandford Supreme Court decision. The Dred Scott decision was a landmark ruling that sent shockwaves through the nation. The Supreme Court declared that African Americans, whether free or enslaved, were not considered citizens and had no standing to sue in federal court. The ruling also effectively legalized slavery in all U.S. territories, further inflaming tensions between the North and South. This wasn't about tariffs or trade wars. This was about the very fabric of American society. The Dred Scott decision injected a massive dose of uncertainty into the nation's political and social climate. Businesses, already grappling with economic instability, now faced a whole new set of risks. The Panic of 1857, while triggered by a confluence of factors, was undoubtedly exacerbated by the political earthquake that was Dred Scott. So what can we learn from these historical blunders? Jackson's bank war stands as a stark example of direct policy action triggering a recession. Dred Scott reveals how political policies, even those seemingly unrelated to economics, can indirectly fuel an economic crisis by shattering stability and confidence. These examples clearly demonstrate the profound impact government actions can have on the economy, even beyond traditional levers of monetary policy or wartime measures. As we navigate today's complexities, let history serve as a reminder. Policy decisions, whether driven by noble intentions or political maneuvering, have far-reaching consequences. And sometimes, those consequences can shake the very foundations of our economic well-being.